Hello and welcome to Stockwatch Live. Now it's a retail heavy week ahead, so let's start with something sweet from Hotel Chocolat. Now someone once said chocolate makes everyone smile, even bankers. Well, I think you can also extend that to shareholders, because investors in Hotel Chocolat have been smiling all the way to the bank. The British chocolatier has seen its share price climb from 264 to 370 pence since the start of the year. And that's no mean feat when you compare its performance to the rest of the retail sector. Yes, life has been sweet for investors in Hotel Chocolat, which has bucked the downward trend that has blighted much of the retail sector for so long now, and especially retailers with a high street presence. While it came to market as a subscription service for chocoholics, today revenues from its high street shops make up about 68% of total sales. It has 110 UK outlets and 10 overseas, and also uses a variety of other distribution channels to its advantage, including selling through John Lewis and Ocado. Due to post full-year results on Tuesday, the group recently said it fully expects annual profits to meet market expectations after revenues rose 14% following an expansion into new markets during the year. The group opened 16 Hotel Chocolat locations over the year, which contributed 5% to group sales year on year. 2 of the new openings were in the notoriously tough-to-conquer United States. The group also entered into a joint venture in Japan, which opened 2 locations in Tokyo. So this isn't just a chocoholics dream, but potentially an investor's one too. So far, managing to also remain debt-free as well is impressive, but investors will want to know that its continuing ambitious expansion plans aren't going to tip the balance and see it come to a sticky end. That's probably unlikely, having achieved what it has and weathered the retail route so far, but more will be revealed when it posts full-year results. The shares are currently trading around 366.5 pence. Now back to the grim reality that is facing the majority of the retail pack and those companies whose fortunes are closely linked with them. For investors in shopping centre landlord turned property investor and car park operator Town Centre Securities, the success stories like Hotel Chocolat are too few and far between. And the reality is that their struggles have a direct impact on companies like Town Centre Securities. So that's why the group took the smart move to shift its focus away from its reliance on retail spaces and add some other property types into the mix. With properties like the Cube building in Leeds, which it picked up for £12 million, made up of 22,000 square feet of ground floor leisure units, together with 50,000 of offices over 3 floors, let to Capita and the government, plus the freehold for 84 apartments leased to Persimmon Homes at a peppercorn rent. And it's this focus on lowering its exposure to retail that could well see it through the worst of the retail rout. Town Centre Securities said its like-for-like passing rent had risen 2.6% for the full year. In a trading update for the year to June, the company also said that its overall occupancy level had risen to 96%, up from 95% a year earlier. So all the signs are that Tuesday's full-year results should bring good news. Its shareholders could certainly do with some. Town Centre Securities shares have been on a downward spiral for close to a year now. This time last year they were trading at 266 pence, today they're 183 pence. And the ongoing uncertainty over Brexit and its knock-on effect on the economy is still a potential fly in the ointment and could remain that way for some time yet. However, if things do start looking up, then broker Liberium Capital's buy recommendation looks arguably more realistic than it would have done, say, 6 months ago. It has cut its price target, though, from 340 to 300 pence. Peel Hunt is a buyer too and has a price target of 260 pence on the shares. Now, off the high street and back in the relatively more upbeat world of online fashion retailing, Boohoo could very well turn out to be the true star of the week when it posts half-year results on Wednesday. Its revelation that it had actually been able to lift its full-year sales guidance, a rarity in these times, after better than expected performance in the first half of the year, saw the shares shoot up to a new all-time high of 280 pence. The company said it now anticipated that results for the current financial year would be ahead of previous guidance, with group sales growth now expected to be between 33 and 38%, up from previous guidance of 25 to 30%. But the group added that it expected earnings margins for the financial year to remain around 10% in line with previous guidance, reflecting anticipated investments across the financial year into the 3 brands acquired by the group in the first half. That good news, though, sparked a flurry of broker recommendations. Peel Hunt repeated its buy investment rating and raised its price target from 325 to 350 pence, and Liberum Capital did the same, while also lifting its price target from 280 to 320 pence. Boohoo shares, which have come back a little way since then from that all-time high, are currently trading around the 271 pence mark. And that's it from me for this week. For more on the companies as they report in the week ahead, go to the Markets and Insights section at fidelity.co.uk. See you next time.